You are watching an episode in our Landlording A to Z series, where we walk you through the steps, skills, and challenges involved with residential rental real estate investing. We share our expert advice, including the tips, tricks, and strategies we've learned over years of managing rental property. Please subscribe to our channel to get notified each time a new episode comes out, and please like and share our content with people you know who might be interested. Thanks for watching.
Hey there, welcome to the next installment of the Landlording A to Z with Landlord Gurus. I'm Chris, we've got Eli here as well. And today we're going to talk about choosing the rental that you want to buy. If you get to that point and you're looking to buy a rental, we're going to look at what factors to consider when looking to buy a rental property. And the topics we're going to cover are deciding on your objectives, budget, analyzing your abilities and limitations, rehab, improve, or turnkey, choosing a market, setting search criteria, putting together your team, choosing financial analysis tools and methods, using analysis tools, and financing options. But before we begin, I just want to remind you to like and subscribe to the video and get notified for when we put all our episodes up there on YouTube for you. All right. Hi, Eli.
Right. Hey, Chris, thanks. Okay, so I'm going to take the first of those, which is to decide on your objectives. We touched on this in our previous video where we talked about whether or not to buy a rental property and kind of the pros and cons of that. So just briefly, some of the objectives that you might have if you're looking at buying rental property, which will inform how you choose your rental property, is whether or not you're looking for a short-term gain. That could be if you're going to improve it and sell it, or you have some reason to believe that the value is going to go up because of conditions in the market. If you are looking for something that has immediate positive cash flow, which is whatever we all love, and that is usually a long-term hold, or creating long-term wealth, which usually, again, is a blend of cash flow and appreciation. And as a subset of that, generational wealth, if you're looking for something that you can pass on to heirs that will ensure their financial security down the road. So those are the broad categories of objectives that most people go by when purchasing rental property.
Right. Yep. Okay. And then for budget, I guess the first thing we want to consider is, are your finances in order? Like how much debt do you have? What's your credit score? Do you have an emergency fund? Things like that, just to make sure your own house is in order before you start, going crazy on buying these properties that putting a lot of money down. So then you need to know, how much do you have for a down payment? How much are you willing to spend for a down payment? How much rent do you need to receive in order to cover your operating expenses, which also includes how much you need to keep in reserve. Things always come up. It's a good idea to set some aside for those reserves as well. You think about how much money you have for immediate improvements or capital expenses that you might need as soon as you purchase that property. You might not always get something that's turnkey, so you might need to have something set aside. And if you need to consider buying a lower price property that needs some work, there's a lot of those out there, in which case you'd need to keep a portion, as I was saying, keep a portion of your capital on the down payment and the rest set aside for those immediate improvements. It's a great way to add value to your property, but it does take careful planning to make sure those improvement costs you can keep down and afford them.
Right. Yeah. So that leads right into the analysis of your abilities and your limitations. So if you're buying a property that needs improvement, for example, or take an honest look at whether or not you're handy, and do you have the time and money and ability and willingness to make improvements or ongoing repairs. Are you able to travel if it's at a long distance? And do you have the flexibility in your schedule to have viewings, maybe in the evening or weekends, and to field maintenance requests and that type of thing? So that'll inform where your rental property and what type of rental property you want to purchase, is your abilities there. Do you like meeting and screening tenants? Which is if you manage yourself, you need to be adept at that. Analyzing numbers and being organized. Those are the things you want to consider about yourself as you decide what kind of a rental property to invest in.
Exactly. Yeah, like you said, all that self-introspection will determine what type of property, what type of project you should look for. Like you said, Eli, do you have the time, the money, the ability to fix and improve the property, or should you choose something ready to go? So, do you want to rehab? Do you want to improve something, or do you want a turnkey property? Or, do you need to hire a property manager? Or in some cases, if it's a particular large enough property, do you want a property with a resident or on-site manager that's living there that can deal with those immediate emergency calls and instances as well? So all that will kind of determine what type of property to look for, and that will help narrow down your search as well.
Right. Yeah. I mean, that could determine whether it's a rehab property, a fixer, totally turnkey, managed or not managed by others, and just the category of property that you're looking for. So next step is to choose a market. So again, some introspection is required. Are you going to stay close to home, or are you going to look farther afield? Sometimes there are higher potential yields on rentals that might not be in your local market. So that's one thing to consider. Can you hire a property manager if a property is kind of out of reach for you? And is that your plan? Take that into consideration, and that'll go into your financial calculus. Making a careful decision, involves being able to research and understand market conditions and the variables that come into play when you're choosing a property. So rent rates, you want to do some careful research on what realistic rents are in any market you're looking for, and what the competition's like, what the different neighborhoods are like. So you want to know that you have that ability and willingness to research these markets. Then look at what the financial variables are in that market. What's the rent trajectory look like? Is it going up? What's the general financial economic outlook and population demographics? Are people moving in? What's the job situation, housing costs, all that type of thing? And there are lots of articles out there if you search on kind of trends and even by markets. So the information's out there.
You can also see, like, is this an area that you're looking at near a university? What are the tenants going to be like? Are they students? Are they, blue collar professionals, white collar professionals? What are all that kind of stuff you can take into consideration?
Right. Yeah. Yeah. So we highly recommend going to see the market you're shopping in. There are some people who will invest from afar, and they generally have a pretty honed familiarity skill set of choosing properties, kind of a checklist, and know kind of off the top of their head, what types of things to look for. Utilities, they'll look at broad things like condition of the roof and the neighborhood and that type of thing. But it's a much more hands-off approach than what we generally advocate.
A lot of times they will look at, the numbers. They'll really look at the numbers, and they've got a good idea on what those numbers mean and how that fits in with their portfolio, whether it's, and we'll talk about those metrics later, but whether it's a certain cap rate or whatever.
Right. Generally, those are people that are hiring property managers.
Yes.
And my personal take on that is that there's a little higher risk because you don't go there and see it in person. You don't see the neighborhood as much in person, and you're leaving things to other people, property managers, and also just kind of more of a numbers view instead of a on the ground view. So anyway, I'm not comfortable with that, but I'm also not somebody who's turning properties and buying up all the time. So, it's a different model. So
yep, definitely.
Anyway, when you are looking at remote rental markets, or even just in your general location, get to know the neighborhood, spend some time, and get help from a realtor or somebody in the market if to get to know it.
Exactly. Yep. And we'll talk a little bit more about that when we talk about putting together your team. So then you're going to start to want to set your search criteria. And this is a point where you collect all your thoughts about your goals, your budget, capabilities, how much you want to work on it, how hands-on, your preferred locations, etc. So then it's time to organize all these and create sort of a written criteria list. We think it's a good idea to put it down in paper, have it there, you can refer to it, and almost like a checklist, right? So now let's say you've chosen your market and you've selected a few target neighborhoods, your team on the ground or your realtor has identified some things for you. You can shop in multiple markets, but as Eli was saying, you kind of want to be there, take a look. So it's hard to shop in multiple markets. It's challenging enough just to kind of have that expertise on one market. So to look at others, you can do it, but it's definitely challenging. But you can compare.
You're going to end up with apples, oranges, and pears.
Exactly. So yeah, then think about whether you want single family or small multifamily or larger multifamily. Like again, a house or a duplex, 5-unit, 10-unit, or in some cases, do you want a 100-unit complex? Think about your budget. Again, think about whether you want a fixer, a rehab property, or something that's turnkey off the shelf that you can, in a lot of cases already has renters in there and you don't have to do anything. And then we can start looking at your target cap rates, your gross rent multipliers, other metrics that you want to use. And we'll talk about some of those later and how to find those and how to identify them. But you're going to put all these things down into your criteria, and you're going to kind of set some targets and kind of go from there, right?
Right. Yeah, I guess that's the launch point from my standpoint, is once you've got your thoughts collected there. So next step is to put your team together. And, that can be varied and a lot of different professionals, but usually that involves finding an agent. You don't have to increasingly, but I still think it's valuable to have somebody who knows the markets, ideally somebody who knows rentals a little bit. Not all realtors do. Having a property inspector and or a contractor or handy person who can help you evaluate the condition of the property and usually just kind of bring to light some potential maintenance or future expenses that you might not anticipate. Even if you do know about buildings, having another set of eyes is a good thing.
Definitely. Things like the roofs and, balconies and decks and things like that, you might not be able to see right off the bat.
Wiring, plumbing, make sure you know what underlying systems are to the best of your ability. So you may also want to have an attorney, and that comes into play sometimes when you're not using an agent so that they can handle the documents, the purchase and sale documents. Getting a lender on board early is really helpful because especially in a competitive market, you need to have, that's a duck that needs to be in a row before you go making offers. And you want to have already figured out what you're eligible for. So having that relationship ahead of time is good. Insurance agent, insurance is going up quickly. You're going to want to do some investigation upfront about what insurance rates are likely to be.
Shop around, for sure.
Right. And you're going to need it right away. I mentioned the contractor or handy person. And then just if you know anybody in the market, or if you can find somebody who's also an investor and is familiar with the nuances of the neighborhood, the type of property, the local laws, what's working and not working. If you can find a local advisor, it's really handy.
Definitely.
Yeah.
Okay. Next, we're going to talk about choosing financial tools and analysis and methods.
Yeah, so there are a number of different metrics, which can be either kind of back of envelope to all the way to requiring some more sophisticated analysis. But often the first metric is the gross rent multiplier. So that's very simple. It's the purchase price divided by the gross rents. So that just gives you a number. Often it's 12 to 16, and the lower number is better. That means that you only need 12 of those gross yearly rent amounts to pay it off. 16 is not as good.
Exactly. It's, if you want to think about it as a quick way to look at how long it's going to take to pay off that property,
Right.
Just with the rental income alone. Yeah.
Very crude though, because it doesn't take into account any of the expenses that you're going to have along the way. So cap rate is again, fairly quick and not extremely precise calculation of what you're likely to make on the property. And what you'll often get a cap rate estimate in the listings. So they'll give you a current cap rate, which is, and Chris, help me here. This is all of the income and expenses and what percentage you're going to make each year after all of those income and expenses based on your initial investment.
Operating income and expenses.
Right.
Yep. So,
right. So yes, I was searching for words for those things. So, but there also be pro forma projections or market rate projections in the marketing material. And, we just caution to be a bit aware of those because that's the rosy picture that the seller and the selling broker have put together to show you how much you can put the rents up and how you can reduce the costs and make simple improvements to make rents go way up. And it's not always very realistic. So you need to do that work yourself. So you'll want to find out what the realistic income and expenses are. Incomes are rents, parking, storage, any income that you can generate, get that all together.
laundry,
Laundry. Then take a look at what vacancy rates are. Might want to take a look at what vacancy rates are in the market as well, average vacancy rates. But ask for records as well from the property that you are looking at for a couple years back. Ask to see leases so you know what their terms are, how soon they're coming up, and how long people are slated to be in the property.
I would also add that, you want to see what the actual rents are that they're currently getting, but also, and then to look at, the ability to increase the rent, whether that's market factors or whether that's legal factors. In some cases, you might not be able to raise rent, or you only raise them a couple % a year. So when you get a pro forma like Eli was talking about, they may have rents that are way higher, but sure, you can get there, but it might take either, a quick turnover if people just happen to move out and you can sign a new person, or If not, it might take several years for you to get your rents up to that level. So it's something to consider.
Or they'll say, well, you can get these rents and you need to do things like putting in stainless appliances and washers and dryers, but there's no realistic accounting there about what that costs.
Exactly.
Yeah. So anyway, it's rosy and crude.
Yep.
And then you want to be careful about knowing what your realistic expenses are going to be. So easy things to miss are pools and the watering, lawns, site maintenance. And then you want to take a look at how utilities are set up. So that's a common one where they may or may not be metered separately. You may, again, have site issues that impact how much outdoor lighting is. So you want to know who's going to pay those utility costs and also kind of what they're likely to be. Look at whether or not the estimated maintenance costs are realistic. That'll also be in the marketing material. Knowing the age and condition of the property, having professionals that help you understand that, that can vary quite a bit. Those expenses can vary quite a bit. And then, deciding which market to buy in should be informed by the returns you can expect, but you also want to consider your risk tolerance, your abilities to manage and do parts of it yourself, and then just the other specifics of your situation, which, only you would know about. So.
Yeah, exactly. Yeah, and then, continuing on that line of these financial metrics and income and expenses and making those calculations, you're going to want to find some analysis tools, and there are a lot of them out there. Tools and calculators that you can use. A lot of them are online. Some of them we have on our website as well.
Most of them.
We'll put a list of all those in the comments below, but there's things out there that will help you, make that a lot easier than you trying to figure out how to do those calculations on, back of an envelope or whatever. But there's one in particular called Deal Check. They call themselves, software that makes it easy to analyze rental properties and other types of buildings and real estate. You can estimate profits. It'll help you find the best real estate deals. And basically all you do, you enter in the purchase price and other income and expense numbers that you have. And again, it's going back to what Eli was talking about, trying to figure out what those realistic numbers are. You can plug those in and the software will then kind of tell you, whether it sort of meets your criteria that we talked about earlier, or whether you should move on. So
does it help you with financing costs, with assumptions about how much you put down and what your rate might be and that type of thing, or is that a separate? There are lots of mortgage calculators out there, so that's definitely possible.
Yes, yeah, it's definitely available. And I think what these guys purport to do is you can do it all in one place, and then you to help you kind of find and narrow down those deals.
Right. Yeah.
And there's also, the rental property calculators. Again, like I said, we've got some on our site. And the ones that are really common and that you want to look at are net operating income, which is the revenue generated from your property after you've subtracted your operating expenses like maintenance, insurance, property taxes, utilities, things like that. Like what Eli just talked about, this net operating income number that you find is also going to be used in other calculations, such as cap rate, which is that, like Eli said, that annual return on your purchase price of the property. And, then also gross rent multiplier, and that's the purchase price divided by your gross annual rental income. So again, it's a quick way to see how long it would take to pay off the property. So those are kind of the main common ones that we like to emphasize, but there are others that you might want to consider. And there's others that lenders are definitely going to consider based on the income that the property will generate as well.
Debt ratios and that type of thing.
Exactly.
Yeah. Yep. Net operating income is probably the most important in my mind, because what I want to know is if I put X number of dollars down and then I own this thing, how at the end of each year, how much more money or less money am I going to have?
Yeah, so, it's all about the cash, right?
Right. Yeah. And we have a net operating income calculator on our site.
Right. Yeah. One thing to also consider with cap rate and also with gross rent multiplier, right? You're going to get these numbers, and there's no hard and fast rule of what is a good cap rate and what is a good gross rent multiplier. You're going to have to kind of, it's useful to compare other properties, and then also to consider with cap rate, right? You might have, you think, well, a higher cap rate, the better. Sure, obviously, right? But it's not necessarily the case, right? You might get high cap rates and you wonder, well, why is it so high? And it's possible that it's just a risky property, right? And that's what people are requiring in order to make that investment worthwhile. And there's, other properties that might have a low cap rate, and you wonder, well, does it make sense because it's so low? I'm not going to make as much money, but in fact, it might be good because it's a safer investment, and that's just, that may be something that you're looking for. So those are things to consider when looking at those numbers. There's no hard and fast rule about what is a good number.
Yeah, that's true. Okay, lastly, we're going to look at financing options, and we're just briefly touching on some of the ways that you can finance rental properties. So there's traditional commercial loans, which are 20 to 30% down. And this is essentially, they're actually looking at the performance of the property, right? So
Yeah.
they're looking at what they're going to have to lend you and what they deem is realistic for how much money that property can generate, and based on that, your ability to pay
Exactly.
that. So yeah, traditional commercial loans, you can go the hard money route where these are private lenders. Generally, they're a little less rigorous about all the requirements and their documentation. They often quick turnaround rates are generally higher, and they're meant to be, and really based on the rates, should be shorter term solutions.
Yeah, I think you'll see a lot of people who are doing flip, quick turnarounds. They might look to hard money loans.
Right, right. Or that's also goes into that BRRR model, which is buy, rehab,
Rent, refi,
rent, refi, and repeat.
repeat. Yeah.
Right. So that because the refi, you're taking the added value that you've created by improving it with the rehab part, and then you're taking some of that money back out and you're putting it into the next one.
Yep.
So it's fairly aggressive, but it, especially in up and coming markets, it can really work, and where you can buy distressed properties. You can also go into a construction or rehab loan, which is usually probably going to be used in conjunction with a traditional commercial or residential loan. And you can pull a line of credit from your house or another property. Again, those rates are going to be higher than you want long term. Or there's this house hacking concept where it's kind of a blended personal residence and investment. You buy a duplex, you live in one, you rent out the other. Maybe you fix the one up, move to the other side, rent that one out. It's an elbow grease approach, which is really a wise move often for people who are getting started.
It is a great way to get started. Yeah. And the benefit is you can get that residential loan interest rate.
That's right. Primary residence. Yeah. Which is, usually the lowest rates you can get. So anyway, that is the common ways to finance. People can get creative. There's always family. But with that, I think we've covered most of the steps that we'd suggest you go through in order to choose your rental property. We will continue kind of fleshing out what you do from there. But if you have any questions, please comment here. And as Chris said before, like, share, and follow our channel here so that you get upcoming episodes of this Landlording A to Z series.
Exactly. Yep. Thanks for watching.
Thanks for watching. Bye.